Years ago, I chose a cheaper commercial loan because at the time that seemed to make the most sense to me. I thought this was the correct decision. It was a 3.89% interest rate. I didn't know a whole lot about it, but lower monthly payments seemed good at the time. I didn't realize there was actually a risk to taking the lower rate. Let me explain that. So I was sitting in front of the loan officer. I was really excited. I was about to buy a rental property, and he had laid out right in front of me. It's a 20-year loan, because that's how most commercial loans are. You have a 5-year locked option, a 7-year locked option, or a 10-year locked option. The 5-year locked option was 3.89% for the first 5 years, and then at the end of that 5-year term, it gets renegotiated based on current rates. 7-year was the same. The 10-year option, because there's a longer time horizon there, it was, I think, 4.89%. I figured lower rate equals lower monthly payment. That makes the most sense. There's nothing wrong with that line of logic. But there was a large piece and a large risk that I didn't explain. The loan officer didn't explain it to me. I didn't take the time to research it. We were both adults. I should have come a little bit more prepared to know that not always the lowest rate is the best option. So what do I mean by that? First off, there is a difference between residential loans and residential mortgages and commercial loan and commercial mortgages. I got this confused because I'm just buying a house, except this house is going to be one that I don't live in, and I'm going to be renting out to other people. Well, residential loans, we understand those. It's typically a 30-year mortgage, and it's a fixed rate over that entire 30-year period. Now, it is amortized, which means that the bank creates their own calculation to, I don't want to say front load, but put more interest up front. And then over time, you pay more principal over that 30-year period. So most of the time, half the interest is already paid within the first 10 years, not 15 because of that period. Well, commercial loans are different. There is a fixed period. Even though it's amortized over 20 years, there's only a fixed period. And that's likely because banks, when it comes to commercial loans, want to limit their risk exposure. The primary reason for this is because you are not really buying just a piece of property. You are starting a business. I feel like this is something I didn't realize at first. I thought I was just buying a property that people would live in, but you were starting a business. And commercial loans are designed for small and large businesses. That's what those loans were built for. And I think it was this understanding that changed things a little bit. If I'm starting a business, I have to think like a business owner. So let's look back at this 3.89%. At the time, 3.89% made a lot of sense. It was a lower payment. But if we look at history, just the past 50 years, it has been higher than 4.89%, more than it's been less than that. So if I had chosen that 10-year option, I was basically saying, okay, over this past 50 years, it's actually been higher than 4.89%, way more than it's been below that. So it actually makes more sense logically to take the 4.89% for 10 years. That way I'm guaranteeing that payment. Instead, what happened was I took the 3.89%, and after 5 years, it went to 7.5%, which is crazy. That was, I think it was equal to $700 extra more per month. I mean, this was a larger property. That hurt. I can't even deny how much of a shock that was. I'm not necessarily saying that you should ignore the low interest rate. You need to predict the future. That's not what I'm saying. What I'm trying to say is there are way more factors that go into purchasing a property than simply looking at rent and expenses. When you're analyzing a deal, you have to think ahead. When I was sitting in front of that loan officer, I wasn't thinking that at all. I wasn't thinking, oh, what are the interest rates going to be in 5 years? No one can predict that. But what we can do is we can take a few seconds to research things and take a guess, right? The 4.89%, if it went down in that 10-year period, maybe I missed a point or two of potential savings, which still is big, but 1 percentage point is not huge. Instead, it went the wrong way. And that wrong way was 3 points, which was much bigger of a risk. So what I'm saying is the downside was much worse than the upside if I had just thought about it. So anyway, takeaway, If you are a new real estate investor, if you're just starting off, I hope this video helps you understand that there's a lot more factors that go into play than simply looking at a deal. I've been doing this for a long time. Feel free to put in the comments if you've got something going on and you need just some free advice. More than happy to help. I'm just trying to help the next generation get into real estate the right way and look at things the right way. Like and subscribe for more. Appreciate it. Thanks.